Welcome to the deep dive. Today, we're really digging into something that might sound a bit, well, back office, balance sheet reconciliation. But stick with us, because while it often seems like just a compliance task, ticking boxes,
Yeah,
we're going to unpack why it's actually incredibly strategic.
absolutely. Because look, accurate financial data, that's the absolute foundation. It's everything. Without reliable numbers, you're essentially flying blind when making big decisions. Critical calls based on, well, potentially flawed assumptions. So yeah, our mission here really is to show you how to take reconciliation from maybe a chore into a real strategic asset for your company.
So what is it, fundamentally? I mean, beyond just matching numbers on a page, it's the main way you actually prove those core financial statement assertions.
Assertions, like what specific? Well, think about cash. When you reconcile your cash account to the bank statement, you're confirming its existence. Does that cash actually exist? Or accounts payable. Comparing your AP ledger to vendor statements. That's about completeness. Making sure all your liabilities are actually recorded. It's basically validating that what your books say is real.
Okay, so it's about proof, about substantiation, not just arithmetic. How does the actual process work? Our sources mention, 6 steps.
Yeah, that's a good framework. You identify your key accounts, first the important ones, then gather the documents, bank statements, subledgers, whatever you need. Compare them. Then comes the crucial part. Investigate discrepancies. Adjust for any errors you find. And finally, you document everything and sign off. But really...
The investigation step, that sounds like where the real value is.
Exactly. That's where it gets interesting. You move beyond just finding, say, simple data entry mistakes. Maybe like transposition errors, where the difference is divisible by 9.
Right, I've heard of that.
But you start uncovering potentially bigger things. Systemic issues, process weaknesses, maybe even the first signs of fraud.
So it's almost like being a detective for the company's finances.
In a way, yes. And you often need more than just simple comparison. We're talking about using analytical procedures.
Okay, analytics. What does that involve?
It means stepping back and forming an independent expectation of what a balance should look like, based on trends, operations, logic. Then you compare your expectation to the actual number. If there's a big difference, you dig in hard.
So things like trend analysis comparing balances over time.
Precisely. Or ratio analysis, like checking if your gross margin percentage suddenly jumped or dipped unexpectedly.
Okay, that makes sense. You're looking for breaks in the pattern.
Yes. And often, the breakdown of a relationship that should be stable is your biggest red flag. That's what we saw in some major frauds, like Satyam. Ratios went completely out of whack. It screams, investigate me. And that leads right into that investigative mindset we talked about. You're not just a bookkeeper anymore.
You're an investigator.
Right. Tracing discrepancies back to the source. Maybe even using statistical tools like Benford's law to spot unnatural number patterns. And crucially, this is key, confirming balances directly with third parties. Like banks, customers, vendors, don't just rely on internal documents someone could have faked.
Okay, this is setting the stage.
Yeah.
Because when this process fails, well, here's where it gets really interesting. And frankly, scary.
Yeah.
You mentioned some big cases.
Oh, absolutely. The classic examples, WorldCom and Satyam, are just shocking for how basic the failures were.
Tell us about WorldCom.
Billions, literally billions, in regular operating costs. The fees they paid to use other companies' telecom lines were just improperly capitalized.
Meaning they put them on the balance sheet as assets instead of expensing them.
Exactly. Inflated assets, inflated income. A simple reconciliation of their property, plant, and equipment, looking for supporting invoices for those huge additions, it would have screamed foul. There were no invoices for billions of dollars of assets.
One. And Satyam.
Even more blatant in some ways. Over $1 billion in cash. Just fabricated, didn't exist. The auditors, tragically, failed to do the most basic step. Get confirmations directly from the banks. They relied on fake statements provided by the company.
So these massive frauds weren't necessarily super complex accounting schemes.
Not at their core. They were enabled by a complete breakdown of fundamental reconciliation and control processes. It underscores how vital this seemingly mundane task really is. It's your frontline defense.
So given these catastrophic failures, what does this mean for, preventing this in our own organizations? How do we fortify things?
2 key pillars, really. First, segregation of duties.
So D.
Meaning different people handle different parts of a transaction.
Precisely. The person who authorizes a payment shouldn't be the one who records it or the one who reconciles the bank account. You need separation between authorization, custody of assets, record keeping, and reconciliation. It prevents one person from being able to both commit and conceal fraud.
Makes sense. And the second pillar? Intelligent automation. Modern reconciliation software is transformative.
How so?
Well, it can automatically match huge percentages of transactions, sometimes 90%, even higher, instantly. It enforces SOD through system roles and permissions. And crucially, it frees up your finance team from that manual grind, the ticking and tying.
That line-by-line checking of everything.
Exactly. Tedious, error-prone work. Automation handles the bulk, letting your skilled people focus on investigating the exceptions, the anomalies, the stuff that actually requires human judgment and analysis. It shifts their focus to higher value work.
So better controls and smarter use of people's time.
Yes. And the payoff is huge. Reconciliation excellence directly cuts costs you prevent fraud, catch errors early, potentially lower your audit fees, but it also actively helps maximize profit. How? Through better decisions based on reliable data, improved cash flow management because you know your cash position, and increased investor confidence. Good controls are a sign of a well-run company.
It really shifts the perspective from a cost center to a value driver.
Couldn't have said it better myself.
So, thinking about everything we've discussed, here's something for you, our listener, to consider. What stands out to you about how your own organization's reconciliation process is shaping its financial future? Or maybe, what hidden insights might it be waiting to reveal about your business?